Hi guys, what's up? So today I'm going to discuss one of the most important ratios, which is liquidity ratio. And here is on the screen. I have tried to put the definition across. So liquidity ratio, as far as concerned, I think these are one of the most important and I think used a lot by the financial analyst. So let's understand what this liquidity ratio means. So if you go through this entire definition, it says that it basically assesses the business liquidity, which is okay, fine. The second point is ability to convert its assets, okay, into what? Into cash. Okay, that's what the liquidity comes into picture. And with whatever cash that you generate, right, are you in a position to kind of pay off your debts or pay off your obligations without any significant? Leave this apart. That's okay. So what a liquidity ratio in a nutshell? Point number one, it basically analyzes the liquidity of an organization. That's number one. Now, liquidity can be cash, okay, or the other way around is what kind of securities, what kind of securities you have as a company, which can be converted into cash, okay, which can be converted into cash, and you can then pay off the debts, okay. Now, this is basic thing that you understand. So if anybody wants to understand the liquidity for the company, if they want to understand how company, how better is the position of a company to kind of pay off the debts. Now, what do you mean by paying off the debt? Basically, like, do you really look at this from a long-term perspective? I mean, if you really have to pay off the debts, right, you can definitely use your cash, right, or you can definitely kind of go for a leverage if you really want to do so. Now, understand this very carefully. Understand this from a point of view of an analyst. Okay. Now, what do you mean liquidity ratio? Like, liquidity ratio will give you an idea that if company is cash rich or if the company has the ability to pay off the debts. I kind of look at this ratio in a different way. In case of liquidation or in case of an emergency, is this company in a position to kind of pay off the debts? Like, does this company has that kind of cash or that kind of securities which they can sell off and kind of pay off the debts immediately on any given day, by the way? Okay, fair enough. Now let's understand what are liquidity ratios are there. The typical liquidity ratios. So these are the liquidity ratios, by the way: the current ratio, the quick ratio, cash ratio, and cash conversion cycle. Okay, now these are the predominantly main four ratios that you have. Now, honestly, there are like four different ratios. I think the only ratio that would differ is the cash conversion ratio. I think this one. I think these three more or less they are one and the same. Now let's understand what are the kind of like. Okay, let's go with the formula and understand the components, which are like common components as far as the formula is concerned. So if you look at the formula of this, so the basic formula, so I'm not going to go one by one, like current ratio, quick ratio, and so on and so forth. As far as cash conversion is concerned, the formula is a little different, okay. But as far as the current, quick ratio, and cash ratio is concerned, I think the basic formula, the common formula is this. So which basically talks about which kind of takes into consideration your cash, marketable securities. Now, marketable securities are those securities which you can kind of sell off immediately and get the cash against those securities. It also has T-bills into it. Okay, a lot of analysts, they kind of forget to include T-bills under the marketable securities, and the most important part is receivable, which is predominantly accounts receivable. Okay, so yeah, so it considers cash, it's considered marketable securities and receivables. Definitely. So this is going to be a numerator. This is your numerator, and what it actually observes is basically is this thing out here sufficient enough to pay off this? Okay, so in a nutshell, this can be current assets upon current liabilities. So all these things out here, it forms a part of nothing but the current assets of a company. Got that? Okay, so liquidity ratio, current ratio, quick ratio, cash ratio, these three ratios would have cash, marketable securities, and accounts receivable in common, and you are doing that because you should be able to pay off the debts. Okay, now let's understand what your book says. Your book says that it should be more than one, something like that. But definitely, I'm going to tell you something beyond the book. Now let's understand by an example, how this thing literally works in a given scenario. Okay, so here I have an extract from two companies. One is the Apple and one is the Kiwi. Okay. Now you can pause this video and you can nicely go ahead and go through the components that I have in here, which are taken from the balance sheet, by the way. So we've got cash and cash equivalents, yeah, which is the most important part. So we've got in short-term investments, okay, short-term investments, okay, fair enough. Receivables, which is again nothing but the accounts receivable that we're talking about. We've got inventories, you've got deferred income taxes. I will not be explaining this headers, by the way. You can watch different video altogether for that. Now, what do you have in Kiwi? Okay, so as far as the Kiwi is concerned, right, what you have is here 51,787. So that's around about 52k dollar, 52k dollar basically as total current asset. Now, I assume it has these things, like, you know, it has these components, and the sum of these components is 52 grand. Okay, prepaid expenses and other things will not be considered in here, and then you have the other current asset. And this is my problem basically. As an analyst, I should get the list of these things. You know, when a company says that other current assets and other these and other that, causes a lot of problem, guys. Anyway, now short-term investments. Okay, all right. Let's have a look at this. Yeah. Now let's have a look at the solution. How you can actually calculate this. Okay. So the quick ratio, I've kind of calculated the quick ratio, by the way, but again, the formula will remain the same for Apple. So what it has, so 21, 120, so that, where is it coming from? So that's 21, 120, which is the cash component. Okay, so let's mark it down. Okay, so this is my cash component. Now what else I have? So 2481. So this is my short-term investments. Okay, so this is going to be short-term investments. And then I think I'm very sure 16849, that's the accounts receivables. Okay, now this thing, basically the sum of this three is divided by your total current liabilities, which is here. Okay, so that's how we got, is like 0.73. okay, fair enough. Okay, so basically you can say that, you know, this thing kind of, you know, can pay off your liabilities. Okay, now as far as, but this is not close to 1, by the way. You know, this is still this is fair enough. I would say that this is fair enough. This is not a really great ratio as far as Apple is concerned, but I think it's a little old data. If you look at today, Apple is amazingly cash rich. You know, it's like one of the richest company in the world, by the way. Let's have a look at Kiwi. Yeah, what all Kiwi has? So that's 51,787. That's the total of cash, AR, and the short-term investments, by the way. Then they have got this deferred income tax 1242. I think it's a different formula to calculate this, you know. So how do you calculate this? Now have a quick look at these things. It's a little different. So what they have done is, from your current assets, okay, they have subtracted all the other non-wanted items. So you have 51787 out here. So you got this number out here. Now what's happening here is, the total assets they have given here, which is the whole total out here. Now what I'm going to do is, basically I am taking out of 51,787, I'm taking out this 1242. These things are, I'm kind of, you know, deducting. So I am taking these things out from the total current assets, by the way. So whatever is left, you know, whatever is left is nothing but my actual current assets, so which will be cash and so on and so forth. So sometimes what happens, in a good way, you get these things. Okay, but sometimes you do not get these things, you don't get the bifurcation. So what do? You have this whole figure, you kind of, you know, subtract this, what are you left with is the final number. So here you have 51 minus so on and so forth. Now what you have is 42,191, that's your current liability, okay, which is close to 1, that's fair enough. Okay, now I think Apple is doing a fair job, Kiwi is doing a pretty good job as far as the ratios are concerned, and that's where you can say, okay, these guys are kind of, you know, close to pay off their debts. I think these guys are doing really good as far as the liquidity aspect is concerned. So I think these companies are, you know, quite liquid. Fair enough. That's it. This is what your book says. Now this is what the formula says, and this is what, you know, basically the traditional way of kind of, you know, calculating the ratio. Now, is this sufficient? That's the main question. Like, as an analyst, how are we going to analyze this data? Okay. Now let me tell you my point of view. Let me tell you my perspective. Now what happens, like most of the time in the interview, when anybody asks you, you know, what are the liquidity ratios, you blindly tell them the formula, you blindly tell them these ratios, and this is what you tell them. This is not really, as an analyst, you should be looking at it, you should be letting the the interviewers know. Even financial modeling, right? There are a lot of people who do financial modeling. They do these ratios blindly. Now let me tell you my take on this. Is this the right way to kind of look at the the liquidity ratio? My take is no. Conditions apply, by the way. Now what's the problem? Okay, the problem is now. So when I say short-term securities, right? Short-term investments. Now the question is how liquid they are. That's the first thing. Yeah, definitely how liquid they are. Okay. When I say you should be able to kind of convert them into cash immediately. So as an analyst, you need to check the ratings of these securities. You need to check the performance of these securities and the companies that they belong to. What kind of securities these are, anything something to do with the treasury bill, something to do with the series and all that stuff. So you got to check them. Okay, you got to check them. So as an analyst, that's my first thing. So now, if I were you, will I take this into consideration? Again, I said subjective. I would basically do a little bit analysis on the securities. If I feel that, again, I will check the schedule in the annual report and try and understand is this the one security or it's a sum of multiple securities in there. So which is sums to say 20K. So I will take only those securities which I am really confident about and which I can convert easily into the market. So that's something I will definitely be doing, but I will not be taking into consideration all of them. And if all of them are quite liquid, I will take all of them into consideration. So that's number one. So that's still okay. Now if you look at as far as securities are concerned, I think still it's okay, because most of the time these are kind of liquid securities and they're kind of good securities. Now the main problem is with receivables, which is accounts receivables. Okay, let's understand a little bit of theory out here. What do you mean by accounts receivable? Okay, so you have done the sales. Okay, a bit of sales is in the cash form and a bit of sales is in the credit form. Okay, my next video is going to be on cash flow statement. I will be covering these things in detailed manner. So account receivable is basically money that you are supposed to receive from the debtor. Okay, so you have given a credit to these guys. They are your debtors. So you got to receive that amount of money from them. Now, when we do this formula, or when we kind of do the ratio analysis, the underlying assumption is, we will definitely be getting this money sooner or later. Okay. Now, let me give you a little idea about accounts receivable. There is something called as aging. There are buckets. The buckets are 60 days, 90 days, 180 days, 360 days. Okay. These are the buckets. What we do not take into consideration is that when I say accounts receivable, okay, the money which is in future, it's a future money, right? It's future money. Somebody is supposed to pay this money back to me because I have given a credit to that person. Okay. The problem with this is the formula, or the concept is, I'm assuming that I'm going to definitely get this money, but there are a lot of subjectives are here. I'm not sure, how the market is going to react. Is this company even doing very well? Is this company even in a position, does this company even have a good amount of cash with it? So, it can pay me back. I'm not looking into this. I'm assuming that, okay, it's a short thing which is going to come to me and that's going to clear my break, which is the accounts receivable. The problem is, you're not even sure, what if the company goes under? The company doesn't exist the other day. This is going to be bad debts. This entire thing is going to be bad debts. Then why should I take this into consideration? If I look at a quick thing, if I do a quick analysis out here, let me just kind of rub this up. If I do the quick analysis out here, you see that this is round about 17K. Okay, so this 17K and the total assets are roughly round about 89K. So yeah, so 17K. If I do the little quick percentage calculation, I think this figure here is round about 15 to 17% of my total current assets. Okay, and that's the main problem. I am considering this is going to be a short thing, but what if the company goes under, or what if there is what if I do not get this money? Or let's say, let's forget about company being under and all that. Let's say, what if I do not get this money and I keep on jumping onto the buckets, I just mentioned buckets. So I'm saying that, okay, this money I'm going to get into 30 days. Company doesn't pay. Then move to 60 days. Company doesn't pay. Then move to 120 days. Doesn't pay. 180 days. This is going to go on and on and on. And that's the problem. Okay. And that is the reason when you analyze any company's liquidity ratio, you should not be considering or should not be really banking on the accounts receivable, because this is something you will be getting in the future. Imagine, had this been like 36K or had this been like say 56K, my liquidity ratio or my current ratio, quick ratio, whatsoever would have gone up. It would have been like 2 or like 2 plus plus. As an analyst, I say, oh, wow, fantastic. This is okay. The company is doing great. Company has current assets and company can actually pay off the current liabilities. So company has current assets, which is say, it's 2 and the liability is 1. Yeah, so you're going to pay off your debts very well. But what contributes, how much is the percentage of the receivables in this current asset? That is something you need to check. The point is, higher the percentage of accounts receivable in any of the current asset, I think there is a problem. Okay. So the point to discuss this thing is that you should check a couple of things like, short-term investments, what's the rating, what's the credibility, what's the company, how's the company performing. And moreover, you should not be looking or you should not be taking or you should not be banking much on the account receivable. So if you ask me, what is the best way to calculate this liquidity ratio? I'll tell you guys to consider two components. One is the cash. Cash is the king. No doubt about that. Cash you should consider, yes, definitely. And the second thing that you should consider is the short-term investment, provided they are good enough. Now, why short-term investments over and above accounts receivable? Because accounts receivable, I'm not sure if I'm going to get the money back. But short-term investment, yes, there is a market for it. If the company is good, if the rating is good, somebody's going to definitely buy this. Okay. So guys, the takeaway for you is, if anybody asks you in the interview, I want you guys to kind of, go beyond the book, which book doesn't teach you, and kind of, give them this analysis. Okay. If you want to stick around, if you want to have a look at a couple of more videos, yeah, you can subscribe to my channel. If there is a question, you can put this in the comment. You can like my page for on the Facebook. Couple of things would be uploaded over there as well. I hope you're clear with the concept called as liquidity ratio now. If you have any questions, please get back to me. Thank you so much for your time, guys. I hope you enjoy the series. Thank you so much.